The ATO always has particular areas of compliance focus when it sees SMSF trustee behaviour trending in a worrying fashion. Kelly Grant from the ATO has joined me today to share with us what some of these more concerning issues are currently. Welcome, Kelly.
Hi, Darren. Hi, everyone. Nice to be here.
Well, it's great to have you, and thank you very much for your time today. Really appreciate that. Look, we'll launch into it. One of the areas the ATO is examining is the inappropriate channeling of income into an SMSF to take advantage, obviously, of the concessional tax rates on offer in the superannuation system. Investments in property development schemes are an example of this. Can you share the main things the regulator is concerned about here?
Yeah, no worries, Darren. So with respect to undertaking these property development arrangements, the concerns we have there is that a number of SMSFs might look to undertake that property development using an ungeared company or trust, and they're not, being mindful of, ensuring they're not triggering, I guess, those 13.22D events under the legislation, such as ensuring that when they're undertaking that property development, there's no borrowing going on in order to see that project through, or that those arm's length transactions are in fact occurring in relation to that development. And of course, what that means is, unfortunately, that particular investment by the SMSF in that entity then becomes an in-house asset. And most of the time that will be over 5%, I guess, of the total value of the fund's asset threshold. So they're then having to, unfortunately, wind up those sort of arrangements and dispose of that particular property in that entity that becomes geared. So that's what we are seeing. We're also seeing situations where, an SMSF will enter into a joint venture arrangement with another entity. And what normally happens is that as a result of the property development that joint venture carries out, the SMSF ends up receiving really quite a disproportionate amount of profits, given the, capital outlay it may have made to that particular project and the little risk that we usually find an SMSF bearing as part of that particular joint venture arrangement. So, that usually can then attract the non-arm's length income tax rules and potentially tax avoidance, Part 4A tax avoidance rules. Another thing we commonly see with these property development arrangements is there'll be, the SMSF might look to acquire it through a limited recourse borrowing arrangement from a related entity, and then those terms the borrowing terms just aren't on arm's length terms. Usually interest isn't being charged at that commercial rate that a commercial lender would lend, and there's not those regular repayments being made. So that, of course, then attracts all that income derived from the property development being taxed at that gnarly rate, and of course when it's disposed of, also attracting CG and the gnarly rate of tax on the capital gains that's made. So that's just something to be mindful of as well. And of course there's our taxation determination on the safe harbour rules for gnarly that the parties should be aware of there. And just one more thing I did want to mention on property development as well is we just put out a taxpayer alert yesterday, 2023/2, and that alerts everyone to just a new arrangement that we've identified, whereby, these closely held groups with these controlling individuals, they look to set up a special purpose vehicle company, say, or trust to carry out this property development. And what happens is the controlling minds each have SMSFs, and they'll end up taking an interest out in this special purpose vehicle. And what usually happens is that the controlling minds will also have a number of entities that engage in that property development project and charge services, for instance, materials at non-arm's length rate. And that leads to quite, large disproportionate profits being channeled into the SMSF that we're also concerned about there. And I think one of the reasons we, got that out in the market too was because I think some advisors might be under the misapprehension that because the SMSF isn't directly involved in the property development there, and it's via the specialist purpose vehicle, that the gnarly rules can't apply, but that they still can apply in that situation. So if everyone hasn't read that alert, Darren, I would recommend they do in fact read that alert. They can get that from our website now under the Super Scheme Smart content that I just did want to quickly mention too, will be rebranded soon as just SMSF schemes or schemes targeting SMSFs, but the content has mainly remained the same.
All right, well, thanks for that alert. Let's move on to the issue of reserves, and reserves have basically been eliminated, but it apparently still remains a bit of an issue. Can you explain why that is?
Oh, look, it's not as much of an issue now, I must admit. We have seen a decline, which is great, in the amount of reserves in SMSFs, and probably because a few of them, have now paid out some of those legacy pensions that were supporting those reserves. It was a big concern for us back in 2017, when the total super balance caps and the transfer balance caps had come into play, because we were a bit concerned that maybe people were setting up reserves to try and circumvent those particular caps. And look, and as a result of that, we've sort of been monitoring the uptake of reserves and the number of reserves in funds since then. And we haven't seen any out of the ordinary sort of trends. And as I said, we've seen that decrease over the last sort of 5 years that we've been monitoring those. So that's really pleasing. And as you know, our view is that an SMSF doesn't really need to have a reserve unless it's supporting one of those legacy pensions. With respect to those SMSFs that, do use that strategy where they contribute a contribution in one financial year and then allocate it the next, we don't really see, that has been a reserve as such. And so I did want to just take the opportunity to point out that people don't need to report, because we are seeing some trustees still report those sort of suspense accounts as a reserve in the return, and they don't really need to do that. So yeah, good to see that over time we are seeing what we expect to see in the level of reserves, and that's a decrease.
Well, that's fantastic. With some of the thresholds that are being obviously spoken about around superannuation right now, withdrawal and recontribution strategies are top of mind in a lot of the discussions in the industry right now. What's the regulator's attitude towards these strategies, I suppose, particularly from a Part 4A perspective? Yeah,
so with these sorts of strategies, look, we think it's best that they come down to sort of a case-by-case basis, right, with these sorts of strategies. So our recommendation would always be, please ask for a private binding ruling, or make sure you get that advice from your SMSF advisor before you engage in these sort of strategies, because we obviously have got concerns when those strategies are being engaged in for the dominant purpose, right, of just ensuring that you can reduce the taxable components on a benefit that you're thinking about ending up paying to your, adult non-dependent beneficiaries when you pass away. So we read a lot and see that a lot of the time they're set up for that sort of purpose. But, unless they've got that sort of a genuine retirement purpose attached to them, and there's nothing like, these regular contributions and withdrawals being made in order to try and reduce those taxable components. And also, we don't want to see things where there's issues where there's like journal entries taking place to try and make those contributions and recontributions happen. There should be genuine payments being made. But and also we're concerned about where there's contributions deliberately made to exceed the caps. So, people are releasing the money, trust members are releasing the money that way to reduce the tax. So they're all the red flags for us with respect to these contribution and withdrawal strategies. But look, I think at the end of the day, though, it really comes down to the facts of the case and the purposes behind why you're engaging in that. And it would always be our recommendation to apply for a private binding ruling if you're not quite sure there.
And usually when I attend any presentation from the ATO about compliance issues, the subject of illegal early access is always usually raised. Is this still an area of focus for the regulator?
Oh, it's unfortunately it continues to remain one of our biggest focuses, and it's purely because we are seeing sort of an increase in that behaviour. Mainly because we're seeing an increase in SMSFs being set up and then trustees just not lodging that first return. And we see that as an indicator of illegal early access. So just to quote some figures, Darren, we had 26,000 funds register in 2021 and 18% of those funds still haven't lodged that first return. And that's a real concern for us because we think they could have illegally early accessed their monies. And even in 2022, the due dates have now come and gone, of course, haven't they, for the lodgement of those returns, especially the new ones, because they only had that date of the 28th of February, and we're still seeing 28% of those lodges, of those funds still haven't lodged that first return. So that's a real concern for us because it could be an indication that someone set up a fund and has illegally early access because, they've been in financial strife or they've been subject to, unfortunately, the influence of a promoter of an illegal early access scheme. And the other thing we're starting to see, Darren, is with the illegal early access promoter type schemes, we're not just seeing simple ones anymore where a promoter has told, has encouraged someone to set up an SMSF and told them they could just take their money out and use it for personal purposes. We're seeing more sophisticated ones, where the promoter's setting up, these associated entities they control and having money go into trusts or companies, and then those trusts or companies are on lending money to the SMSF members for purchases such as home loans. So there's more of a trail of entities, you could say, attached to some of these arrangements now that we're needing to trace through, just to see how is that money being ultimately used at the end of the day. So, we're obviously trying to, through our Super Scheme Smart, soon to be branded as schemes targeting SMSFs, we will be including some of those arrangements within the new rewrite, which should happen, I think, in the next week or two to warn trustees and the industry about that. Because ultimately, at the end of the day, we want the industry reporting these sorts of things to us as well, so we can get onto them as quick as possible.
Yeah, that would make sense. And I'm sure everybody will be looking out for that new information when it is released. Look, thank you very much for your time again, Kelly, and for sharing those insights with us.
Yeah, I hope that was helpful. Thanks, Darren.
Now, Kelly will be discussing these ATO compliance priorities in more detail as part of a bonus on-demand session for the SMSF Professionals Day 2023. To register for this and other on-demand content related to this event, please reference the details on screen now. Thanks again for your time today, Kelly, and it's been a pleasure talking to you.
Yeah, likewise. Thank you, Darren. Thanks, everyone.